Good morning, everyone. Thank you for joining another episode here of the YVR REMO show. We appreciate your time and attention as always, and this should be a good episode. Everywhere you look and read right now, there's a lot of comments out there about what's going on in the U.S. and the banking system, and it certainly seems like another world war or a financial crisis is kind of on edge. So we brought on Danny Horanyi out of the U.S. Actually, I'll let Danny give a little bit of a background on himself. But Danny's a co-creator of Neo Home Loans, which is an extremely large brokerage throughout the U.S. Very successful brokerage, and also a co-creator of Tribe Coaching. And I can speak to Tribe Coaching personally because we are active in the coaching program, which is absolutely phenomenal. But yeah, anyways, just to kind of dig into the episode a little bit, and then Danny, I'll let you jump in here. We wanted to dig in. Again, there's a lot going on. There's a lot of terminology out there that most people, even myself, wouldn't really understand until we really dig in. And we just want to kind of demystify what's going on and really bring it down to, layman's terms. So maybe before we dig into that, Danny, you can just give a little bit of background on your business.
Yeah, absolutely. And I'll be pretty quick with that as well, just so we can get into the meat of this, Deryk and Tyler. So Neo Home Loans is actually it is a part of a bank called Luminate Bank. And so in the US, there's actually a lot of different ways that mortgages are originated. So you have money center banks, right? Like those that receive deposits from borrowers and then lend that money out. You have what's called independent mortgage banks, which generate mortgage volume and then sell that volume on the secondary market. And you have brokers who interface with multiple banks, and then those banks then take on those loans and sell them out on the secondary market. And so those are the kind of the key pillars of the mortgage industry. And I fall in a kind of a hybrid version of banking and mortgage banking, right? Kind of married together, which gives, I think, a pretty unique perspective on what's happening right now in the U.S. mortgage market and in the banking sector.
Yeah, that's great to know for sure. And I mean, we have similar but different structure here in Canada, obviously, and we'll probably save that for another episode just for the sake of everyone's time here. But yeah, you know what? Why don't we dig into it here? So obviously, I guess it was a little over a week ago. Silicon Valley was kind of the first big name that come across this situation. And there's terms out there in regards to bank runs, and I know that they were very invested in kind of the tech industry. So maybe we could kind of start there with what sparked all of this. And there's been a bit of a domino effect for certain reasons.
At the risk of getting too technical, Deryk, I'll just be very high level with this. The first thing is to understand, how do banks make money, right? And this, when I say that, I mean money center banks, not mortgage banks. So it's pretty intuitive, right? Banks make money by taking on deposits. So they have clients that come and those clients collectively give them millions, if not hundreds of millions of dollars. Those dollars sit in the bank, right? And then those deposits are effectively, for lack of a better term, borrowed from their clients, right? So the client brings the money in, right? The banking customer, and then that person is paid a return on the investment that is on their sometimes even checking accounts, their savings accounts, their money market accounts, whatever it is. The bank is returning more dollars out to that customer than the deposits are valued for the bank. So what does the bank have to do? They have to figure out a way to make a higher return on those dollars than they're paying their customers to house their money with that bank. Right? So then they do various activities to try to generate a spread between the interest rate that they're paying their customers and the interest rate they can acquire out in the open market for those same dollars, right? Aggregated up, which makes total sense. And, the most intuitive thing is, okay, I'm going to take in, some money, Deryk, and I'm going to give you let's say we go back to the world of 2020. I'm going to give you 0.25% per year on your money. Well, it's pretty easy for me to win on that trade, right? I can go and lend that money out at 2% and have a 1.75% arbitrage on my 0.25% that I gave you. That's pretty easy to win in that trade. So then what was happening as the Federal Reserve started to drive interest rates up, the federal funds rate is the shortest term interest rate you can get. It's the overnight trading rate between the banks charge each other, but it has a ton of other parts of the economy that are based on that rate. So the federal funds rate directly influences what's called the prime lending rate, which is the rate that is paid on HELOCs, most credit cards, most of the short-term debt that's out in the world. So the federal funds rate is going up and up and up. That means the shortest term rate of return is going up and up and up. And so now banks are having to fight to retain their customers by driving the rate that they're paying out on money up and up and up, right? You can go online right now and search, right? You're going to find banks that are paying 4+%, 4.5% on savings. So now the hurdle for that bank to then go out and earn more money or earn enough money to justify paying that customer that spread, they have to chase a bigger dragon, right? Like, to make that difference. Now, what happens in the meantime, right? The other side of that trade. So banks paying out 0.25%, easy hurdle. They go and buy a bunch of bonds, right? So let's say they have 100 million deposits. They go out and buy $100 million of bonds. And let's say the bonds are paying 2%, right? Just again, that same threshold. You got a 1.75 headroom. Well, a bank goes and buys a bond for 2%. They buy it for 100 million. Let's say the average rate of interest goes to 4% on bonds because the federal funds rate is going up, which means the short-term yields are going up. If you have a $100 million bond that's paying out 2% and the going rate is 4%, how much is that bond worth? Quick math, it's worth $50 million because the going rate is 4%. So in order to produce a 4% return on a 2% bond, it becomes worth $50 million. Okay, no big deal, maybe, unless you're a bank where your customers get into financial distress, the tech sector, and they need their deposits back, right? Because now they need to actually take the money out of the bank to go and pay their bills, right? Pay payroll, pay for, research and development, whatever they're going to pay. Now, all of a sudden, I have a $100 million bond that's worth $50 million, and somebody just asked me for their cash back. But I don't just keep cash, because if I keep cash, I'm paying out somewhere between 0.25% and 4.5%. I can't keep cash. I lose money every day if I have cash. I have to have other assets. But my assets that I bought just went down in value. And I'm simplifying this math. Obviously, it's a lot more nuanced, but directionally, this is what happened. The depositors came for their money. The assets that were having to be sold, $1.8 billion or something of bonds that needed to be sold to kind of recover the dollars that were being called on, was worth far less than it was originally purchased at. And it created obvious havoc, for the banks. Then depositors start to learn that the assets that back their deposits maybe aren't as valuable as they thought. And then other depositors come for their money, and it's a snowball rolling down a hill.
That's a really good explanation. That was going to be kind of my next piece tailing into this. As soon as there's a bit of a lack in confidence, right? Like, so once that messaging gets out to the public that there is some concern within a bank or banks consecutively, people will then typically run in and try to pull your money out because you don't want to be there if the bank's going to go under, right? So then that deposit issue becomes a much bigger issue very, very quickly. And then there's obviously a regulation component to all of this, right? Like a lot of these balance sheet type lenders, that's what we call them in Canada anyways. As you mentioned, you need to balance out your debt to your deposits for numerous different reasons. And if you are not balanced accordingly, the regulators can simply shut you down or take over the institution. Is that similar model in the US?
Yeah, and there's significant regulation around banks. And there's, I'm going to admit right now, Deryk and Tyler, I'm not a banking expert, right? That's not where I've kind of put a lot of my time, but I'm adjacent enough to that industry to have been familiarized with some of the terminology. And if you look at some of the changes that have happened, right? You look at the timeline. The Dodd-Frank Act, which was implemented in 2010 in response to the financial crisis, included a lot of additional oversight for banks, and in particular banks that were valued under, or any bank that had deposits over 50 billion. I think it was something like that. I'm probably off by a billion here or there, but it was somewhere in that neighborhood. Well, that regulation was significantly, or that threshold was significantly increased in recent years. Essentially, the regulation pressure came off of banks in recent years because of modifications to the Dodd-Frank Act. And the Silicon Valley Bank would have been encompassed in the $50 billion or whatever the number was. I may be misquoting it. But it was not included, even though it was the 16th largest bank in the country, it was not included in the higher level of regulation. So no way to know for sure that having that additional oversight would have caught this, the house of cards that was being built through purchases of bonds and then the federal funds rate going up. And if you think about it, the Fed has, hundreds of PhD economists, right, working for them. They could have also kind of potentially future casted out the externalities, the unintended consequences of their actions on other sectors of the economy. But to your point, there is a lot of regulation. That regulation failed to catch this particular weakness in the banking sector, and we have this the result. Now, the great news about the kind of confidence building action is that the FDIC or the government came in and said, hey, we're going to guarantee these deposits even beyond the normal insurance policy, right? Because the deposits are typically insured by the government through the FDIC insurance, but they actually extended that insurance beyond what they otherwise did in order to kind of shore up the confidence in the banking sector, so people knew their money wasn't going to just evaporate overnight.
A question with that, Danny. Now, is that like those FDIC insured depositors? Like, is that strictly for me? Like, I'm an everyday banking client with Silicon Valley. Or is that extending to their commercial department and businesses that have various accounts there? Like, is everything insured top to bottom?
No, Tyler, I don't know the answer to that. To be really just candid with you, my understanding of the way that the government is interceding as it relates to Silicon Valley is that they're protecting all the depositors, including the commercial depositors. But I'm not confident in that. But if you think, again, this is just me hypothesizing here. The thing about commercial depositors is that those commercial depositors are employers of people, right? So the cascading effect of employers losing their deposits on a broad economy, when you're talking about billions of dollars, there's a lot of cascading impact that can happen if you have, people not getting their daily wages or their weekly, monthly wages in order to, cover their bills. That there's a lot of other dominoes that hit each other if those commercial accounts get taken out. So my expectation is that it was, or the way I read about this was that it was everything, but I couldn't tell you that for sure.
Up here, I think it's important for our listeners to know just similar but different banking systems. Like, a lot of people would even probably call the Canadian banking system a bit of an oligopoly. There's really 5 big ones and then maybe a handful of smaller ones where, down south, I think I heard there's something like, 3,500 banks across the country, could be even more, that have maybe that 50 billion deposit amount. For a lot of our listeners up here, they're hearing Silicon Valley Bank, Signature Bank, First Republic. Like, are you seeing now the big banks in the States sort of swallowing up a lot of that business? Like, are any of the big banks kind of shaky from this kind of action?
Well, it's hard to say for sure without, total transparency. And this is not something that I have, that's not information of their back-end books that I have access to. But what I have seen just anecdotally is that there's definitely a flight to safety. People are looking at, larger name brand banks as kind of strongholds. Now, what I believe people should really be looking at is the to the best of their ability. Again, this is not super transparent information, but really, what is the asset that backs up their loan, right? Because that's effectively what the question of a depositor, that's what they should be asking, right? I'm going to give you my money. I'm going to lend you my money to be distributed out by your institution. What is the asset that backs up my deposit, and how secure is it? Because if you asked any person that had a, economics 101 background, whether a bond was a secure asset to back up a deposit, they probably would have told you yes, right? But if they didn't understand the full economics of the bond market and how the actual face value or the open market value of that bond changes as interest rates change, right? It doesn't change the actual value of the bond in terms of face value. It only changes how liquidable it is, or how quickly you can get it, off your books and convert it back to cash. prior to maturity, most people aren't going to understand all the nuances of that. What's interesting, Deryk and Tyler, as it relates to the mortgage industry, which I know you both are very intimate to, is that some of the best ways to stay responsive is to have a really robust residential lending arm or commercial lending arm, because you're actually deploying out your money in real time, right? So the value of the dollars are X, the open market rate for borrowing is X plus, and so you can kind of keep in concert. The tricky thing is that most money center banks, or balance sheet banks is what I heard you call it, they don't have really robust lending arms. Some do, but many do not. And it puts them in this position where they have to go and seek other assets to generate a return to then, create that arbitrage so that they can make a profit while still retaining their deposits. There's another concept called hot money, right? So there's meaning like if there's a large depositor, they have a willingness to move their money around depending on which bank is providing the most return. Because if you have large dollars, outside of the opportunity cost and hassle of moving your money from one institution to another, if the spread is big enough, it makes sense to do that. Because let's say one bank is paying 3.5%, another paying 4.5%. Well, if you have, $5-10 million, you might actually move your money, which then means that the banks are competing with each other over the fundamental value of the dollars that are coming in from a rate of borrowing, which then puts even further pressure for them to create a return when you're talking about what assets you acquire to create that spread. So it's kind of this weird machine that's almost feeding on itself right now.
Well, I mean, you bring up a good point, which is mortgages, and that's why all of our listeners are here, and that's what we're all really good at. So why don't we, we'll spend the next 10 minutes or so here touching on, markets and any potential impacts. And something that came to mind, Tyler, you brought up a good question is, are banks going to be looking at, policies differently? What I would personally expect to see if this was a Canadian situation, I would assume that lenders would start to tighten up mortgage regulation, especially if these are institutions or any type of a mortgage lending company that is potentially on the verge of having some potential issues. I would think that their appetite for risk would tighten up quite a bit. I don't know if you've seen anything. I know we haven't had a lot of time to see any real true impact or guideline changes, but have you seen anything of that nature yet?
Well, Deryk and Tyler, fortunately, the regulations on the U.S. side from a mortgage perspective are extraordinarily healthy, right? Default rates are down significantly. The quality of loans being made right now is extraordinarily high. So when we look at this challenge, this is not actually a mortgage challenge. There could be a mortgage solution that gets put and brought forward as long as the capital markets kind of settle down and allow for mortgages to be made in a healthy way. The thing I think that would be the most interesting to your listeners, Deryk and Tyler, is that let's future cast out, right? So I'm saying, hey, the house of cards is coming down, dominoes are starting to hit each other. What's on the other side of that historically, right? When stuff like this happens, what happens in the broader economy, and then what happens in the mortgage markets? Well, typically what happens in the broader economy when we start to see these dominoes hit each other is that we move into a recessionary type of situation where the economy starts to retract. And there are so many factors right now. Any listener can look this information up. Consumer debt is at an all-time high, never been higher in history. There's an inverted yield curve that's starting to collapse. There's a lot of signs right now that either we're in the U.S. in a recession or very quickly will be in one. And historically, what happens in a recession is that the Federal Reserve will start to slash interest rates. So you'll start to see maybe one more rate increase because there's very much a lagging kind of data that drives the decisions of the Fed, tends to lag pretty significantly. So we're likely to see one more, call it 0.25% increase in the federal funds rate, and then very shortly after that, months, not years, we'll start to see the Fed cutting rates in order to stimulate what will appear at that time to be a pretty weak economy. Now, the thing that's driven interest rates up in the US and in Canada, which you guys have shared in the past, that rates are definitely higher than they were, call it 18 months ago. That's a global event. The thing that causes that to happen is inflation, right? Because for the same reason that Silicon Valley Bank didn't want to have 2% bonds on their books anymore, right? That was a dangerous thing because they had a fixed return and the actual cost of money was going up, creating a negative spread for those assets that they held. For those very same reasons, people who buy mortgages do not want to be caught on the wrong side of inflation, because you sign up for, so many years of return, which if the rates go up in that period of time, you're actually losing out on that. So inflation drives rates up, deflation drives rates down. And so usually when an economy is weakening, it's a deflationary event, and high credit debt is extraordinarily deflationary, because all the same dollars that would have been used to buy things is now going to pay interest expenses, right? In addition to all those purchases that were put on credit being pulled into the current year instead of the future year where they would have happened if they were made with cash. So what does this mean for us in the mortgage industry? It means we're highly likely to see interest rates go down sometime in the next 9 to 18 months, maybe even sooner. And they could go down pretty precipitously, which has its own set of problems associated with it, because anytime there's market volatility, there's winners and losers that cause that to happen.
Yeah, volatility is a great word, really, top of mind currently, because if we were to reverse 2 weeks, looking at Bank of Canada, and inflation data was starting to get a little bit more under control in Canada anyways. But I do know that, and correct me if I'm wrong here, but the Fed was still on pace to probably continue to hike interest rates at least a few more times, is what I kind of had read.
And Deryk and Tyler, if you're I wouldn't consider myself a conspiracy theorist, but my background's in economics. And also I feel like just through the work that we do, we get to learn a lot about human behavior and what motivates a person to make a decision one way or the other. You guys probably experience that quite a bit when you're interacting with your customers or your investors, right? A lot of it has to do with just human behavior. And when I look at some of the chain of events that kind of got us here, where there is evidence, right, depending on what you look at, that inflation has started to taper off. But what the Fed has done, apparently, and obviously I'm not in their meetings, right? I'm not invited to their committees yet. But until the time that I am, I just have to speculate. And one of my speculations, and this is not me, coming up with this idea, I've heard it and it sounded like something that aligns with human behavior, is that Jerome Powell, the head of the chair of the Fed, he is very opposed to what's called quantitative easing, the printing of money, right? And we've had a tremendous amount of that in the U.S. since 2008 crisis. If you look at what's called the M1, M2 money supply, you can see it's almost like a hockey stick that just goes up to the sky. That's money being added to the economy. Well, Jerome Powell said, I don't want to do that. Well, if he doesn't want to do that, the only lever he has is the federal funds rate. Increasing it to slow the economy, decreasing it to stimulate the economy. When it goes to zero, the only lever left is to actually print money and put it in. He doesn't want to do that. So it appears as if they've adjusted the inflation readings to focus in on areas of the economy that lag more significantly, to show inflation for a longer period of time, to justify more increases, so that there's more headroom to then stimulate the economy before you get to zero and have to do quantitative easing. So all that to say, the likelihood of us seeing rate drops and a slowed economy and improved interest rates on the mortgage side for your business and ours are made even more likely by the action of targeting data that appears to be more inflationary than maybe the broader economy is, to increase the pain of federal funds increases, which then could potentially cascade into an even deeper recession than would have otherwise been if the broader scope of data was actually appreciated. I don't know if that made a ton of sense, but basically it seems like the game's getting rigged a little bit in order to build up a lot of federal funds rate reserve.
I think if anything, Danny, that really kind of wraps it around full circle for us and why we brought you on, just for our Canadian listeners, like why we're so focused on what the Americans do and what the Feds do is because generally what they do, we have to follow. And the reason for that is typically as the Americans raise rates, if Canadians don't, if our central bank doesn't, that brings down the value of our currency, right? And we're talking about why banks or central banks are raising interest rates is to fight inflation. So if the Americans are raising rates and the Canadians aren't, the value of our dollar goes down. We bring in pretty much everything and a lot of it from the States. So that means it costs more for us to bring goods into this country, which is inflationary. So I think, you know, we just kind of wrapped it around all in full circle while they're different economies. And it's not just the Canadians, the rest of us generally got to follow what the Americans do.
Well, we're all connected now, right? It's a global economy, right? And no two economies are more connected than ours that I'm aware of, right? We're such close neighbors and partners, and it makes total sense. I mean, we can go on for probably another half hour about monetary policy and how that how that impacts what we're doing. But I know that we only have just a couple minutes left. Any other thoughts or questions that I can, share to help your listeners, Deryk and Tyler?
I think just one kind of last message that I'd love to hear your opinion on is that the actual real estate market. Now, this is just generally speaking. I know there's a lot of different markets and different pockets, and they're going to react differently. But we've talked about a couple different things. We've talked about recession. We've talked about interest rates coming down. If we recall what happened 2.5 years ago with COVID, when rates came down, our real estate market took off to a point that was unforeseeable. What are your expectations for real estate going forward, generally speaking?
Short answer, I believe real estate will continue to go up. And I have a couple of reasons for that. So the first one, I want to just create this construct where, again, I shared my background's, my education's in economics. That was what I got my degree in college in. I thought I was going to become a CPA or a tax preparer from that, but I ended up, falling into mortgage. But I still deeply love the entire kind of macroeconomic process. And there's only two fundamental factors in an economic process, and that's supply and demand. And price is derived from those two things. So we have awareness around demand, right? We know how many people are being born in both of our countries every year, and we know what the average age of a first-time homebuyer is. So we kind of have a look back from 33 years ago to understand what our demand side of the trade looks like. We also have a good understanding of what our supply side looks like, right? That comes from homes being built, right? That's the only, because there's some homes that are getting functionally obsolete every year. So even if we didn't have anyone born, we would still need to build houses just to keep up with the fact that there's homes that are degrading to uselessness every year. So you add all that up, you say, okay, home prices will continue to rise if supply continues to fall behind demand. And I'm not as familiar with the Canadian housing market, but my understanding from, especially the West Coast market is that the building of homes is not easy. There's a lot of red tape to kind of build a house in your guys' immediate market. And therefore, there's not a lot of houses being built, but there's still people migrating or being born, et cetera. And so what I believe the construct is that we have, to the extent that house prices went down in the last 6 months, it is more emotional than tactical. Because tactically speaking, there isn't really anything that would motivate a price decline because there's still more demand than supply. Now, there was some demand, tactical demand that came out of the equation, right? People no longer can afford the payment that they thought they were going to be able to afford. That the interest rate went up, so some people got taken out. We had such a imbalance of supply demand that tactical extraction of those people that can no longer afford the payment to buy the house they want to buy because home value went up and interest rate went up at the same time, it doesn't account for all of the decline that we've seen in demand. So my hypothesis is that demand decline is primarily emotional, not tactical. People still have babies that need a new bedroom. They're still getting divorced and they need new houses. They're still downsizing. They're still moving out of the area to a new job. All those things are still happening, regardless of what the economy does or doesn't do. And therefore, as soon as we see interest rates start to stabilize and decline, that emotional demand decline, right, that was not tactical, is going to start to drain away. And we're going to see the same pressures in the local markets, those high demand markets that we saw back in the 2020s, 2021 timeframe.
Love it. That was perfect. We appreciate you jumping on here, Danny. This is very good insight. Thank you for taking the time to do this. And for anyone listening, we'll make sure that everyone can get access to Danny's contact information, access to Neo and Tribe websites. And yeah, really appreciate you jumping on here, Danny. That was great.
It's my pleasure, guys. Anytime you want me back, just let me know.
We will. We will. Okay, take care.
Cheers, team. Have a good one.